Good morning, everyone. We are from the AC 1A. So today we are gonna present about conceptual framework and financial reporting for our course Financial Accounting 1. My name is Nur Shafi Anis and my card metric numbers is 20 DAC 25F 1002.
My name is Samuel Swenway. My number matrix is 20 DAC 25F 1801. I forecast DAC 1A.
My name is Priscilla Mo. My card matrix number is 20 DAC 25F 1067. I'm from DAC 1A.
My name is Christine Tao Jingwei. My card matrix is 20 DAC 25F 1006. I am from DAC 1A.
On this slide, I will introduce the scenario we're working with. Zahara Trading Sendirian Berhad is a retail machinery retail company. Recently, the company has seen a significant increase in internet sales. This is mainly due to changing consumer behavior, where more customers prefer shopping online. To support this shift, the business has also invested in a new e-commerce platform. Now, with these changes in operations, some accounting issues have come up. For example, when exactly should the company recognize online sales and revenue? Should be at the point of order, payment, or delivery? Another question is about delivery fees. Should this be recorded as an expense or should they be treated as a source of income? At this stage, management is uncertain about how these items should be properly presented in the financial statements. That's what we will be exploring further in this presentation. Building upon the scenario that Zahara Trading faced, let us now turn to the key accounting concerns identified. Relevance means that the information in financial reports should actually help people make decisions. In other words, the information should make a difference. Think of it like this. If you are deciding where to deliver a product, you might want to know the cost of shipping per weight of parcel. Those details are relevant to your decision. On the other hand, how long the parcels will be arrive. In business, the same principle applies. For example, if a company's online sales are increasing every month, this information is relevant because it gives us insight into future profitability. Investors, managers, and even customers can use this to make smarter decisions. Next is faithful representation. Now, let us move to the second quality. That is, faithful representation means the information must show the real situation of the company, completely without bias and without errors. It should be like a clean mirror that reflects the true financial position. For instance, imagine a company charges delivery fees to customers. If the accountant mistakenly includes those delivery fees as part of sales income, the financial report will give a misleading picture. It will look like the company earned more sales than it actually did. It is not faithful representation. So, to be faithful, information must be complete. All necessary details are included. The neutral, not biased to make the company look better or worse. Next is free from error, as accurate as possible. So, to summarize, relevance is about providing information that is useful for decision making. Faithful representation is about ensuring that the information truly reflects the company's reality. When both qualities are present, financial information becomes reliable, understandable, and valuable for everyone, whether you are an investor, a manager, or just someone interested in how the company is doing.
The objective of financial reporting is to provide useful financial information. This information should be helpful in making decisions. It must also be trustworthy, transparent, and relevant. The user of financial reporting includes objectives of financial reporting. First, evaluate growth and profitability investor. Second, lender assess your ability to pay back. Third, assess the financial stability of creditor. Ensure information is trustworthy and transparent and for financial reporting to be useful, information must have two key qualities: relevant and faithful representation. Relevant information includes decision making. Example, if online sales are growing steadily, they are a sign of future profitability. Faithful representation means the information is neutral, complete, and free from errors. Example, delivery fee should not be mistakenly included in sales.
Let's examine the improving qualitative aspects of financial data. The first is comparability, which aids users in assessing results across time and among other companies. By employing similar accounting practices, it guarantees the financial statements can be meaningfully compared. The second is verifiability, which indicates that the data is supported by proof. For instance, in e-commerce, we use bills, delivery notes, and transaction records to verify the accuracy and dependability of the data. Third, timeliness. As soon as a transaction takes place, it should be recorded. Any delay lessens the information's usefulness in making decisions. Lastly, understandability. Accounting rules and financial reporting should be simple to comprehend. Users can quickly and easily understand the meaning of the figures when they are presented clearly. Together, these four qualities improve the usefulness of financial reports and build trust with users. Now, let's move on to discuss revenue recognition and the suggestion we made. Applying the correct accounting standard, which is MFRS 15 and IFRS 15. Revenue from contracts with customers is crucial. First, a precise framework for determining when and how to recognize income is provided by this standard. Second, only after the customer has control over the product should revenue be recorded. This implies that the customer is now in charge for the item and that the business no longer has ownership or control over it. There are two crucial circumstances to think about. Revenue should be recorded at the time of sale if there is a transfer of risk, such as when a consumer checks out online and the good is instantly available. However, revenue should only be recorded once the customer actually receives the product if the risk is transferred at the time of delivery, such as when the product is shipped and delivered later. Adhering to these guidelines guarantees that revenue is accurately reported and compliant with global norms. We need a clear method for handling shipping fees for Zahara's online sales. Initially, we should record the courier payment as a delivery expense and recognize the amount as delivery income when the consumer is charged a delivery fee. For instance, we record 8 ringgit as revenue and 6 ringgit as expense if the consumer pays 8 ringgit for shipping and we pay the courier 6 ringgit. This demonstrates appropriate matching and openness. Second, there is no delivery revenue if the company covers the cost of delivery, as in the case of free shipping offers. Rather, the cost of the courier is considered an operating or distribution expense. Sales or the cost of items sold should not be deducted from it. Lastly, the financial statements comments must include a notice of all delivery policies. This covers the impact of free shipping offers. the recognition mechanism, and whether Zahara is the principal of agent in shipping. To put in briefly, record revenue and expenses if the customer pays. Consider it a distribution cost if Zahara pays. Additionally, it should always be made explicit in the notes.
I will explain about the economic method of delivery charge. There are two main situations. First, if the customer pays a delivery, the company should discuss its revenue together with the delivery cost. For example, when you buy product of shopping of Lazada and you pay a some delivery fee, the company record the payment at the price is income, but it must also record a delivery expense. Second, if the company instead pay of the delivery, it should not be recorded as revenue. Instead, it should be considered at a distribution cost of the opening expenses. For example, some business like GrabFood or Foodpanda sometimes offer free delivery promotion. If they cast the business bear the cost, it must be shown as expenses in the financial statement. Last but not least, in both cases, it is very important to clearly discuss delivery charge if the note of the financial statement so that you understand the company position. Another slide is requirement, transparent, and discussion. Okay, so firstly, another important is the company should update its accounting position to reflect the new treatment. Stakeholder such as shareholder, auditor, and even customer must be informed of the charge so that everyone have a clear understanding. For example, if the company decides to check how is record delivery charge, it should pay us the financial number before and after the charge. It must is discrete of investor and creditor to compare professional. And one, the new mentors is at least consider must be maintainer of further years because considers help the bus trade in the financial report. The last part, I will explain about all the conclusion. Okay, in conclusion, the late graph of online shelf declares company as a model accounting producer by at least LFRS and MSRS standard. Company can interstate among the distributor, inspector, and the auditor. The concentrate framework guarantees the financial information is reliable, transaction, and consumable among distributor year. Of example is 1 year delivery fast are recording a revenue, and the next year they are recording as expenses using will be conferences, but we provide standard reporting discount concentrate and useful of discrete making. Okay, this is the end of our presentation. Thank you for your reading. Bye.